Okay, let's unpack this. Welcome, everyone, to the Account Academy Deep Dive.
Glad to be here.
Now, this deep dive is part of the Account Academy podcast, which is developed by Pipeline IQ. They've been the leading account research firm since 2006.
That's right. Pipeline IQ has worked with, hundreds of top tech firms, giving them really actionable insights on key enterprise prospects. It's all about driving effective ABM and enterprise sales.
Exactly. And this deep dive podcast is actually the industry's first sales intelligence podcast. We're blending AI analysis with Pipeline IQ's 2 decades of expertise in ABM and account research.
So our goal today is pretty clear, right?
Yeah, laser focused. We are diving into the business and technology priorities of Bank of America. Huge topic. The aim is to give you strategic takeaways you can actually use.
Things to help build more effective ABM and go-to-market strategies specifically for BAC.
Right. We're looking past the headlines, really trying to get down to the tactical priorities driving them in the mid-2020s.
And what's fascinating with Bank of America, I think, is just the sheer scale, obviously, but also how incredibly consistent their core strategy is.
You mean the responsible growth philosophy?
Exactly that. It's been championed by the CEO, Brian Moynihan, for, 15 years now? It's not some new buzzword. It's really the bedrock.
And they deliver that across their main segments.
Across all four. Consumer banking, GWIM, that's global wealth and investment management, global banking, and global markets. The message is consistent everywhere.
That clarity, it really does seem to come through when you look at their recent growth numbers, especially loan growth.
Oh, yeah.
If you look at the back half of 2024, they saw this huge acceleration. Management kept saying it reflects client optimism.
And the numbers back that up. The pace really picked up. Q2 saw about $9 billion in loan additions.
Okay.
Then Q3 jumped to $19 billion.
Wow.
And Q4 hit $20 billion in additions. That's quite a ramp up.
That's a powerful curve, yeah. And is that just U.S. consumer or?
No, it's broader. Commercial loan growth specifically was solid, too, up about 5% year over year in Q4. But, you can't really talk about BAC without mentioning their wealth management engine. It's enormous.
Right, the GWIM segment. What kind of scale are we talking?
Get this, $6 trillion in total client balances under management.
$6 trillion, okay.
Yeah. And GWIM added 24,000 new households just in 2024. Merrill Edge, which is their sort of consumer-focused investment arm, crossed $500 billion, $518 billion in balances.
That's just immense volume.
Yeah.
But, okay, where's the immediate sort of cash generation really humming?
Well, global markets, their investment banking and trading side has been on an absolute tear.
I saw that. Wasn't it like 11 straight quarters of growth?
11 straight quarters of year-over-year revenue growth, yeah. They hit a new full-year record, nearly $19 billion in sales and trading revenue.
Which is pretty unusual for consistency in that market's business.
Highly unusual. And that really leads us straight into their main financial priorities: NII, net interest income, and operating leverage.
Okay, NII. The spread between loan income and deposit costs, basically.
Right. And BAC is projecting NII to accelerate maybe 6% to 7% for the full year. They're expecting a really strong exit rate in Q4 2025, somewhere around $15.5 to $15.7 billion for the quarter.
Now, obviously, higher interest rates help a lot of banks there, but what's specific to BAC? How are they driving that NII growth so efficiently?
That's the key strategic point, I think. It's a combination. It's core balance sheet growth, getting more loans and deposits, plus this ongoing repricing of their fixed rate assets.
Meaning older loans rolling off.
Exactly. They're cycling out older loans that might have been yielding, say, 2% and replacing them with new assets yielding closer to 4%. And management sees this as a multi-year thing.
Okay.
Crucially, they point out it generates billions in NII each quarter with very minimal extra expense attached.
And that is where it gets critical for anyone listening who wants to sell into BAC. That high-margin NII growth is basically funding their intense focus on expense discipline.
Absolutely. They have this clear goal, almost a mantra. Grow expenses at about half the rate of revenue growth. They're targeting only 2% to 3% expense increases overall.
That seems incredibly tight for a bank that size.
It is, and you have to remember the history here. This bank has been, obsessive about automation and re-engineering for over a decade.
Right. You mentioned the headcount reduction earlier.
Yeah, since 2010, they've gone from roughly 100,000 internal roles down to about 55,000. That's not just trimming. That's fundamental change driven by tech and automation.
So the bar is already incredibly high.
It is. The low-hanging fruit for efficiency is long gone. Any new solution, any new technology you bring has to demonstrably contribute to that operating leverage to hitting that 2-3% expense target.
Okay, so efficiency is paramount. But where are they actually looking to expand beyond just growing the core?
Good question. Two areas really stand out strategically. First, within their global corporate investment banking CIB unit, they're actually broadening their target market.
Broadening. How so?
They're strategically lowering the minimum client revenue size in certain markets. Historically, it might have been, say, $2.5 billion in annual revenue to be a target client. Now, in some areas, they're looking at clients down to $1 billion in revenue. They're looking for new pockets of growth, especially overseas, maybe.
Interesting. And the second area you mentioned links to their mission.
Yes, sustainable finance. This is huge for them. It's not just PR. We're talking a $1.5 trillion sustainable finance goal by 2030.
1.5 trillion.
Yeah, and $1 trillion of that is specifically earmarked for the environmental transition.
Wow.
They are fully committed to achieving net zero before 2050. And that's across their financing activities, their own operations, and even their supply chain.
So for anyone selling into CIB, for example,
It means pretty much every conversation about lending or infrastructure or data or reporting now has to involve climate risk management and ESG enablement. It's reshaping needs across the whole company.
that's a perfect bridge to their technology strategy then, which they openly call a strategic competitive advantage. Let's start with just the scale of digital.
Yeah, I mean, digital isn't just one way to interact with BAC anymore. It's pretty much the default.
Like what percentage?
90%, 9 to nail. 90% of all client interactions are digital now.
Okay, that's massive.
And the user numbers reflect that. 48 million active digital users, that's up 4% year over year. Digital logins hit 14.3 billion, up 12%.
Billion with a B.
With a B. And here's the kicker. Digital sales now make up 55% of their total sales volume, up from 49% the year before.
So digital isn't just service, it's the main sales channel now too.
It's the primary engine for acquisition and conversion, yeah.
And driving a lot of that experience is their AI, particularly Erica.
Erica, yeah, their virtual financial assistant. The number are staggering. Over 2.5 billion interactions since it launched in 2018.
And it's not just for consumers anymore, right?
No, that's the interesting part. They've integrated Erica right into Cash Pro Chat, which is their platform for global banking clients.
And it's actually resolving issues.
Resolving more than 40% of client inquiries completely autonomously. That's real workforce augmentation happening right there.
And it speaks to their wider AI strategy. They call it model agnostic, I think.
Yeah, that term model agnostic is key. What it means, practically speaking, for, say, a vendor listening, it means BAC isn't interested in building its own huge foundational AI models like some tech giants might. They don't see that as their core business.
So they leverage existing ones.
Exactly. They leverage the big industry investments, the public models, and then focus their own quite considerable internal AI teams on building very specialized workflows and integrating these AI capabilities deeply into their existing systems.
They mentioned having quite a few models in production.
Yeah, 250 AI models running in production currently. And they hold over 1,400 patents related to AI. That tells you they're mature, they're advanced, and they're looking for very specific targeted applications, not just R&D projects.
So the main goal isn't just AI for AI's sake. It's about efficiency and tackling the backlog.
Precisely. Management has explicitly said they see AI as maybe the only way to realistically get through a technology backlog that, frankly, they could probably never clear otherwise with human developers alone.
So using AI for things like fraud detection.
Fraud, customer service optimization, finance processes. They even mention running natural language advisory agents right there on the trading desks in global markets.
Augmenting the traders.
Right. It's all about freeing up their human staff for what they term more innovative work. It's efficiency, but framed as augmentation.
Okay, let's shift slightly. Back on the consumer side, generating those core deposits and relationships. Payment seems critical.
Oh, absolutely core. Payment strategy is seen as fundamental to future growth, especially for attracting those net new checking customers, which is a key metric for them.
And Zelle has been a huge part of that story.
Huge. They processed 1.6 billion Zelle transactions last year. That's up 25% year over year.
Wow.
And the quote that really stood out was that Zelle transactions are now larger than cash plus checks added together for the bank.
That really paints a picture of behavioral shift.
Total transformation. And they're not stopping there. We know they're actively looking into stablecoin development too.
Right, either doing it themselves or maybe with a consortium.
Yeah, it just signals they intend to stay right at the front edge of payments infrastructure as it evolves, because the whole tech stack for them is viewed as this strategic weapon
Needs constant work, constant re-engineering.
to be nimble, adaptable, and of course, incredibly secure. Which brings us to risk and governance.
Which, in banking, is obviously non-negotiable. How seriously is security embedded?
Right to the very top. The main board of directors, and it's worth noting, it includes members with real tech backgrounds. They oversee the Enterprise Risk Committee, the ERC.
Yep.
And the ERC, in turn, directly oversees the Global Information Security Program, or GIS,
So the CISO and CTIO report up through that structure.
regularly. The Chief Technology and Information Officer and the Chief Information Security Officer report directly into that governance structure. It ensures security isn't just an IT cost center, but it's completely aligned with business strategy and risk appetite.
That's deep integration.
Yep.
Okay, so pulling all these threads together, the growth, the NII leverage, that strict expense cap, the massive digital shift, the AI focus. We can probably boil this down for our listeners. What are the key alignment themes if you want to sell technology or services into Bank of America?
I think there are two really critical ones that emerge. The first, and it's driven directly by that financial discipline we talked about, is what I'd call the efficiency imperative, augmenting the workforce.
Right. So for you listening, this is crucial. Your solution must directly help them hit that 2 to 3% expense growth target.
And we're not talking about fuzzy, long-term potential ROI here.
And to be clear, immediate.
And realized. You need to show how you automate the mundane, how you accelerate clearing that internal tech backlog we mentioned.
And crucially, how it frees up their expensive human capital.
Exactly. Freeing up people for higher value, strategic, preferably revenue-generating work, especially in those really capital-intensive areas like global markets, or maybe helping manage the complex advisor incentives in wealth management, which is a big expense line. If you can't show that linkage, it's unlikely to get funded.
Okay, that's theme one, the efficiency imperative. What's the second key theme?
The second is more about the strategic direction, deepening the primary digital relationship via payments and advisory.
Ah, okay. Connects back to that obsession with being the main bank, the primary household relationship.
Totally. And doing it digitally. So for you, this means your solution ideally needs to plug seamlessly into their existing major client platforms.
Like the mobile banking app or Cash Pro for the business clients.
Or even leveraging the Erica AI framework. The goal is anything that supports acquiring those net new checking accounts or helps convert wealth clients into using the full suite of banking products.
And payments remains key to that digital stickiness.
Payments is the absolute backbone. Zelle now, future stablecoin efforts later. Enhancing that engagement through payments is critical. If your solution makes that digital relationship deeper, stickier, more valuable to the client and the bank, you're aligned.
Okay, so to quickly recap that picture for everyone,
Right.
we've got a bank hitting its stride with accelerating loan and deposit growth,
But under incredibly strict expense control, fueled by relentless automation.
and a very clear model-agnostic strategy for scaling AI and digital tools like Erica.
All aimed at boosting efficiency and deepening that client engagement right across the board. The strategy feels very stable, the execution disciplined, capital is flowing, but it's very targeted.
Right. Which leads us to that final thought for you to consider. Given BAC's stated strategy, their focus on balance sheet growth, maintaining those high capital buffers, remember, they're comfortable running about 50 basis points above their requirement.
That's a significant buffer.
And given their continued investment in capital-hungry businesses like global markets and specialized lending, how could your technology or service be positioned uniquely, not just to save money, but to actually help them redeploy that capital buffer, those efficiency gains?
So turning efficiency savings into fuel for growth.
Exactly. How can your solution become the accelerant that helps them put that capital to work faster and more effectively in their fastest growing, most strategically important areas? It's about moving beyond just cost savings to enabling strategic capital allocation. That's the real challenge and maybe the biggest opportunity.